It has been revealed that in 2019, China's economy grew at its slowest pace in nearly 30 years. The results were unexpected, with the 6.1% GDP growth rate for 2019 near the bottom of Beijing's target range and significantly down on 2018's rate of 6.6%. The ongoing slowdown appears to be a result of all the well-reported challenges that the world's second-largest economy has been facing, including the fallout from the trade war with the US, China's rising debt, as well as cooling domestic demand. The GDP figures, widely seen as a gauge on economic health, came just 2 days after China and the US signed their first step in a trade deal, putting on hold the near 2-year trade war. The battle does at least appear to be cooling off, with China and the US signing phase 1 of a deal in which China has agreed to buy hundreds of billions of dollars worth of products from the US. Analysts predict that this will boost business confidence. The trade war is far from over, however, with many US tariffs on Chinese goods remaining in effect. Washington has made it clear that they will use this as leverage when negotiating the next phase of the agreement. Other issues affecting China include issues related to the banking, manufacture and real estate sectors. Ting Lu, Nomura's chief China economist, has stated that some people believe that there could be a stabilization or rebound in the property market this year. But my view is that the correction is not over yet, especially in the lower tier cities. Whilst the GDP figures are disappointing for China, there are several indicators that show that activity picked up in the final days of 2019. Industrial production, for example, rose 6.9% year-on-year in December, a figure which was higher than market expectations. Fixed asset investment also rose by 5.4%, showing capital expenditure was picking up. This number appears to have been boosted by investment into services and high tech, rather than the more traditional housing and manufacturing sectors. In fact, manufacturing investment, a measure of the health of the factory sector, was one of the more concerning numbers from the data, falling 3.1% last year, a record low, also highlighting the toll that the trade war has taken on the country. Urban disposable income is another worry, rising just 5% last year, an all-time low, as China has been attempting to move to consumer-driven development rather than rely on the investment-focused growth that has left the country with a large amount of bad debt. A fall in the birth rate last year to a record low of 1.05% has also alarmed demographers. The country ended its controversial one-child policy in 2016. Now all married couples can have 2 children. However, these efforts have arguably come too late, with many now seeing single-child households as the norm, given the policy was in place for 35 years. Yi Fujian, a senior scientist at the University of Wisconsin, commented that China should have stopped the policy 28 years ago. Now it's too late. As a result of the policy, there are also now more than 34 million men in China than women. By 2050, as much as a third of the country's population will be made up of people over the age of 60, placing severe strain on state services and the children who bear the brunt of caring for elderly relatives. This demographic decline is also a signal that the country could in the future be facing a shortage of young and able workers needed to help fuel its growth in the future.